Thank you, Amy, and a warm welcome to all of you dialing in today. My name is Scott Nance, and I'm the head of business development at Impact Assets. And I'm happy to be joined today by Ron Cordes, the co-founder of Impact Assets, as well as the Cordes Foundation, and the former board chairman at AssetMark. I'll be formally introducing Ron and turning the presentation over to him just a little bit later. Today we're going to discuss some very timely topics, connecting philanthropy and impact investing through the use of donor-advised funds. Our goal is to provide you with some actionable ideas on how to expand your value proposition and the connection you have with your clients. I'm going to start things off by highlighting some important philanthropic and impact investing trends that represent a paradigm shift in how the affluent and women and millennials in particular view their capital. Then I'll walk you through the basics of donor-advised funds. For those of you familiar with donor-advised funds, this will be a good refresh and set the stage for Ron's part of the discussion. So first, let's put some impact investing trends in perspective by taking a look at some interesting statistics. Up at the upper left, you can see $40 trillion. That represents the wealth transfer to women and millennials barreling down the tracks at us over the next 15 to 20 years. Second statistic at the lower right, $8.72 trillion. That's the total assets in sustainable and responsible investments in 2015, which was up 33% in 2014. We seem like we're getting a little background noise here. If I could ask all the participants to please mute their phones. Thank you. 75%, you can see that statistic. That's the percentage of clients who said their children had never even met their financial advisors. Given that, no wonder only 2% of children stay with their parents' advisors, according to PricewaterhouseCoopers. And there was actually an article in yesterday's Wall Street Journal talking about this. And on that note, 66% of children fire their parents' financial advisor after they inherit their parents' wealth, according to an Investment News survey. So look, whether it's 66% or 98% client loss on generational transfer, it doesn't really matter. You'll want to be getting out ahead of that. And another 66%, although there's this high degree of interest in impact investing, clients are reporting that 66% of their advisors don't know about it. Now, the statistic 24%, that refers to donor-advised funds being the fastest-growing charitable vehicle, more than foundations, trusts, CRTs, and other vehicles, up 24% from 2013. And our client experience, anecdotally here at Impact Assets, is that DAPs and philanthropy are a great way to bridge that generational divide, as kids and their parents can more easily come together over grant-making and impact investing. You see the statistics, 70% versus 55%. That refers to the percent of women who are interested in socially responsible investing strategies compared to 55% of men. And finally, 92% of millennials believe businesses should operate with purpose and values. And this extends to the companies that they work for, the investments they want to make, the consumption of products and the brands that they want to interact with. So as professionals in the financial services industry, I think what these numbers indicate is that there's some catching up to do as the landscape shifts beneath us, and advisors need to be ready to lean into that wave, not be playing catch-up. Now here's a look at some recent headlines. It's clear that mainstream players are taking notice of impact investing and acting on it.
The conference has been muted.
Goldman Sachs, JP Morgan, Morgan Stanley, and Merrill Lynch have all started impact investing groups in the last few years at the request of their clients. And asset managers like BlackRock and Bain Capital are launching impact investing products. Also, as you might be aware, there are a number of policy developments around fiduciary duties supporting the mainstreaming of impact investing. In late 2015, the IRS issued guidelines saying that foundations can take impact factors into account in making investments without jeopardizing the foundation's charitable purpose. And also in 2015, the Department of Labor issued guidelines saying that ERISA-regulated pension funds can take impact factors into account when making investment decisions. The investments still need to be market rate, but impact factors can serve as tiebreakers, and the guidelines acknowledge that impact factors can actually drive financial returns. Now, as some of you may not be familiar with impact assets, here's a quick overview. We're a nonprofit financial services organization, which might seem a bit unusual. Our mission is to increase the flow of capital into investments that offer social and environmental returns in addition to financial returns, which is essentially a textbook definition of impact investing. We were spun out of the Calvert Foundation in 2010, and Ron Cordes, who you'll be hearing from shortly, is one of our founders. Now, the primary way in which we enable investors to access impact investments is through our donor-advised fund called the Giving Fund, which has over $300 million in assets under management. On the financial product side, we also offer two structured notes that are thematically focused on sustainable agriculture and microfinance opportunities. And finally, Impact Assets is widely viewed as a thought leader in the industry, and we provide a number of resources to the public to raise awareness and increase knowledge about impact investing. And I'll talk more about some of these resources toward the end of the webinar. So now let's talk about some key reasons to have what we call the giving conversation. And if you as advisors are concerned about the automated advice movement, the robo-advisor movement, and how to continue delivering distinctive value to your clients, then there's a need to move beyond the core of just providing investment solutions. One way to do that is to help connect clients with their values and to give them options to express that. So introducing donor-advised funds to your clients can be an excellent way to begin that process. Some of the key reasons for you to have that giving conversation include helping to retain a valued client or maybe attracting new ones whose advisors don't engage them with these types of ideas. Rounding out the financial planning process in a holistic sense. Optimizing the tax impact for your clients. And you also probably have clients who experience significant liquidity events or other situations where they come into a substantial amount of wealth and want to do something philanthropic. And finally, having the giving conversation also affords you the opportunity to engage with the next gen, and you'll recall from a few slides back just how important that will be for retaining them as clients in the future. Now, as I already mentioned, donor-advised funds, or DAFs for short, are the fastest growing philanthropic vehicle in the U.S. So a few statistics around that. First, overall charitable giving increased to $373 billion in 2015. That was the best year ever. DAFs represented 21% of that total charitable giving in 2015, and the average DAF account size is $235,000. So this was really important because for the first time in history, a DAF charitable sponsor actually surpassed the United Way as the largest charity in the country. And so it has people asking, why DAF? Donors, financial advisors, and industry leaders all want to learn more about DAFs and why they've experienced such tremendous growth and what makes them so popular. Baby boomers and millennials in particular want a close connection to their philanthropy and to track their charitable impact. And DAFs provide that flexibility and management that donors are looking for. We at Impact Assets predict that DAF growth will continue to be strong as donors grow more knowledgeable about using them as a vehicle to implement their charitable vision. So now let's talk about the nuts and bolts of how a donor-advised fund actually works. The first step is that the client makes an irrevocable donation to a charitable organization offering donor-advised funds to establish their account. Now, this is an important consideration because even though the client continues to see the donated assets on their statements and in their portfolios, again, it's an irrevocable contribution. However, in return for that, they receive immediate tax benefits in the form of a deduction for that donation. One of the great things about DAFs is that a wide variety of assets can be contributed to establish the account. Of course, cash works great, but also public securities and illiquid assets such as real estate or fine artwork. And we even had one instance at Impact Assets where a client donated the royalty rights to 3G bandwidth spectrum. So again, a lot of flexibility around what can be used to get the tax deduction and open the account. Next, the assets in the donor-advised fund grow tax-free, similar to the way they would in an IRA or retirement plan. There are generally many investment options offered, including public and private equity and debt. And for larger DAFs, typically $250,000 or more, an advisor can direct it as a privately managed account. Finally, the client has an opportunity through an online portal to direct charitable grants from the fund and can also create a charitable legacy by naming successor advisors which in most cases are their children or other family members. Another important consideration here is that the client is free to decide where those charitable grants will go and the timing of those grants. And the only restriction is that the charity must be a legitimate registered 501c3 charity, which could include religious, educational, or health research organizations, for example. And some DAF sponsors, like Impact Assets, also allow for international grant making. Now, this next slide tries to answer a number of questions that were most commonly asked. And very often, clients with $1 million or more will want to compare a donor-advised fund against creating a private foundation. Some key takeaways here. If you establish a private foundation, your tax deduction is going to be limited to a smaller percentage of your AGI than if you donate to a donor-advised fund, which is considered for tax purposes to be a public charity. If you donate cash, the limitation is 50% of adjusted gross income for a DAF, but only 30% of AGI for a private foundation. And if donating appreciated securities, it's 30% for a DAF and only 20% for a private foundation. Now, if a client isn't able to take all of the deduction in the year that the assets are contributed, there is a 5-year carry-forward period. Regarding IRS distribution requirements around granting, there are none for a donor-advised fund, although we find in practice that most clients do make grants from their DAFs every year, somewhere in the order of 15 to 20%. It's completely up to the client. If they set up a private foundation, there's a 5% minimum requirement that they grant out, and there's an excise tax that is owed if they contribute less than that. Anonymity is another reason that some clients prefer donor-advised funds over foundations. And with a private foundation, there's an annual requirement to file a tax return with the IRS that discloses all granting activity. And that information includes how much money you're giving and who you're giving it to, and it becomes publicly available and relatively easy to find online. In a donor-advised fund, the donor can request that grants be made anonymously, so for privacy reasons, that can be a key benefit. And finally, setup and ongoing administrative costs tend to be high for a private foundation, whereas for DAFs, the administrative costs typically run in the 0.25% to 1% range. When I'm out traveling and meeting with advisors, I'm often asked, which of my clients should I be thinking about as potential candidates for a donor-advised fund? So here are a few key triggers that will help you identify which clients it may make the most sense for. And while DAFs are not necessarily a tool for every client, when the right situation arises, they can be very powerful. One of the more common situations we see is where a client has a pending liquidity event. So if you're an advisor who works with entrepreneurs, it's very important to get out in front of prior to any valuation or before they sell their business. Appreciated securities with a low basis, maybe it's a client who's worked for a company for a long period of time and accumulated a lot of the corporate stock. A DAF can be a great tool when they're having a high income year to help offset some of the tax liability. And of course, purpose-based planning clients, those with more than $1 million in assets, are also potential candidates. And finally, you probably have a number of clients that come to you near the end of every year and want to make numerous donations from their investment accounts to a variety of charities. A DAF makes that granting process extremely easy through the use of an online portal to make those donations. Here's an example of the power of donating appreciated stock to help your clients maximize their tax deductions in a big income year in particular. This illustration shows not only how to maximize the deduction, but also to maximize the amount that becomes available for charitable purposes. At Impact Assets, more of our DAFs are funded by appreciated stocks than any other type of asset. Now to recap, here's some key takeaways to remember about donor-advised funds. First, they're the fastest growing philanthropic vehicle in the U.S., and they accounted for 21% of all charitable giving in 2015. The key reasons for this growth are flexibility, ease of use, and cost. And anecdotally, from our experience at Impact Assets, we see this trend continuing in a substantial way. Second, DAFs are a flexible alternative to private foundations and allow for higher tax deductions, greater privacy, ease of administration, and lower costs. In general, the rule of thumb for even considering a foundation would be a minimum of $3 to $5 million in assets. But what we're seeing are clients with more than $10 million in some cases choosing to open a DAF over a foundation. And finally, donor-advised funds can be an excellent vehicle for impact investing, and Ron will have much more to say about that coming up. It's now my pleasure to introduce our featured speaker. I've known Ron
The
Cordes.
conference has been unmuted.
It's been my pleasure to introduce our featured speaker, Ron Cordes. I've known him professionally for about a dozen years, and the truth is he was the biggest influence in me deciding to pivot my 2-decade-plus career in the hedge fund industry into impact investing. Ron's a co-founder of AssetMark Investment Services and executive co-chairman of AssetMark. He's a co-author of The Art of Investing and Portfolio Management and was recognized as an E&Y Entrepreneur of the Year in 2005. Ron co-founded the Cordes Foundation with his wife Marty with the goal of advancing market-based solutions that address the world's most challenging problems. He speaks extensively on impact investing and achieving meaning and purpose in an encore career, and he's been profiled in multiple publications, including Fast Company, Forbes, Financial Advisor, Financial Planning, and Private Wealth Management. Ron chairs the Executive Committee for Impact Assets, and he's also co-chair of Opportunity Collaboration. In addition, he serves on the Advisory Committee for the Clinton Global Initiative and is a board member of the U.S. Global Leadership Coalition, Fair Trade USA, and Microvest Holdings. And with that, Ron, I turn the presentation over to you.
So let me just launch it. Again, this is Ron Cordes. Thanks, Scott, for the kind introduction. And I just wanted to take a couple of minutes and share with all of you kind of my personal story of how I got into this field of impact investing and some of the things that prompted myself and a couple of other co-founders to start Impact Assets, and a little bit more granularity about the field of impact investing, the interplay of public and private investments, and kind of how things fit together. So first off, just a quick background. Like many of you, I graduated from college in 1981, came into the industry as a junior financial advisor, freshly minted Series 7, had the opportunity with a couple of partners to buy into a practice in the San Francisco Bay Area, and we found ourselves in the early 1990s, right at the beginning of the movement from commissions to fees, and that ended up leading us to the good fortune of having the opportunity to build the industry's first turnkey asset management platform, which became AssetMark. And we had a wonderful run at AssetMark, but by 2005, as the CEO of the firm, I was interested in kind of what my next act could become and maybe moving, if you would, from success to significance. And my wife and I were involved in a number of charitable projects. Long story short, my partners and I sold AssetMark in 2006 to a global insurance company. My wife and I formed a family foundation. So if you'd have asked me 10 years ago what I'd be doing today, my rough answer would probably have been some type of philanthropist, supporting issues around the world that were important to us, around women and girls empowerment, and global poverty, and education, and economic opportunity. Well, we do all that today, but they've actually become a smaller part of what we do in the foundation because we kind of happened into, if you will, the emerging world of impact investing. Amy, next slide. So one of the things that happens when you start a family foundation is you get lots of advice. And the advice that we got early on was quite simple. They said, here's the way foundations work. You set up a foundation, you put 100 cents in, and every year you give away 5 cents or more, 5% being the minimum, as Scott mentioned with private foundations. And that's how you do it. The other 95%, just knock yourself out. You're an investment guy. You make as much money as you can. Don't really worry about how you did it, because if you're successful financially, then that 5% becomes a bigger number the following year. And I remember raising our hand in some early meetings and saying, well, wait a minute. We're not the Gates Foundation. We have several less zeros in our balance sheet. So there's only so much that we can accomplish in solving big problems out of our 5% grants budget. How can we activate the other 95%, we called it, of our portfolio? And in 2007, the advice we got was, well, it isn't done. It's not, fiduciary rules don't allow it, IRS rules, Treasury rules don't allow it, philanthropy rules don't allow it. Well, 3 sets of lawyers, 2 sets of administrators later, by the end of 2007, we realized that it was entirely possible to get involved in this field of impact investing, which as of yet hadn't even been named at the time. So at the end of 2007, we brought our board together. We made a commitment to move 20% of our portfolio on the private side over to some of these newly emerging investments. And so through the first half of 2008, We found funds and individual investments to build that 20% of the portfolio. Again, we're focused in the developing world. We're focused on economic opportunity, women and girls, fighting poverty. So many of the things that we invested in were things like microfinance and small business development and working capital loans to entrepreneurs in the developing world. So we're proud of the fact that by August of 2008, we'd actually allocated that entire 20% of our portfolio. Well, then, of course, September of 2008 happens, the world implodes, and by the end of the year, we're becoming concerned, frankly, about the fact that we're having impact in this 20%, but what are the financial results going to look like, and how much of a financial hit might we have taken for these types of investments? Well, wouldn't you know, when everything was mark to market at the end of 2008, not only were these not the worst performing investments in our portfolio, but this 20% actually turned out to be the best performing in our portfolio. And so that then led, as I was transitioning out of AssetMark, having shepherded into the global insurance company that we had sold to, I came out as a free agent. I came into this field. Impact investing was just beginning. And I began to look at this and say, here's the only uncorrelated investment category that I happen to have found in my career. It performed better than anything else in my portfolio, and these investments were actually having impact from a social environmental perspective on the ground. Is there actually something here? And could I somehow be a proponent or a leader in this field, given the experience that I've had in financial services? And that's basically what led to the creation of Impact Assets. In 2009, one of our founding partners, the Calvert Foundation, sponsored a study called Money for Good. They interviewed about 1,100 high net worth and affluent investors. And the concept was, if you were presented with this type of investment, would you be interested in exploring it further? 48% said yes, interested or somewhat interested. 40% said maybe, and 12% said no thanks. So nearly half of the investors were interested. But then when the drill down came, what we realized in the survey was that no one, as of yet, was doing it. And the primary reason why is because the financial advisor gatekeepers, if you will, we were keeping those gates shut because we as financial advisors just weren't comfortable with working with clients in this area. So that basically led to the creation, as Scott is described, of Impact Assets, a nonprofit financial services company designed to equip both investors and their financial advisors with the resources to be able to be impact investors. And one of the things that we also, on a personal level, wanted to do was to give everyone the opportunity to do what we were doing in our foundation, which was both granting and investing through a philanthropic vehicle. And we realized that the enormous growth and popularity of the donor-advised fund market allowed for folks to be able to do this without having to have the resources or go through the administrative burden of creating a private foundation. So the genesis of Impact Assets was, could we create this vehicle that would allow anyone with a minimum investment quite small, even $10,000 to $15,000 to start, to not only grant money, but also begin to become an impact investor and put their money to work in that way. So today, fast forward to 2016, our portfolio, or our foundation, is now multi-generational. Our daughter, Stephanie, came to become vice chair of the foundation in 2014. It's been directing, along with our portfolio director, two millennials. They've been directing a lot of the work we're doing in the millennial community. And we've moved our portfolio to 100% impact. And that's where I wanted to move now. So let's move to the next slide, sustainable investing definitions. So often when I say our portfolio is 100% impact, people may get the impression, so you're 100% in microfinance or 100% in small private entrepreneurs around the world. And no, that's not necessarily the case. For us, we've always maintained, as an endowment type portfolio, about a 50-50 mix of public markets and private markets. We actually entered the impact investing space through the private markets, through that original 20% that we'd invested in 2007 and 2008, and had expanded that up to 30 and 40%. It's interesting. When our daughter came aboard in 2014, we brought in a portfolio director who was also a millennial. They began to look at what we were doing, they started to talk to their contemporaries in the millennial space. And what millennials were basically saying is, why aren't you 100% invested this way? And we had not been invested for impact in the public markets. And part of that was an old paradigm that I still had at the time that I think many people even still have today. And that paradigm, I think, is kind of why we put together the sustainable investing definition. So if we start with the private markets at the bottom, impact investing is really about direct investments made into companies, organizations, and funds with the intention to generate social and environmental impact alongside a financial return. So we're not talking about philanthropy. We're not talking about recoverable grants. We're talking about the ability to make an investment. Microfinance is actually a great example that generates a financial return, but also addresses the social or environmental problem. On the public markets, in the 1980s and 1990s, there was the advent of kind of SRI, socially responsible investing. And it was really all based on the concept of excluding companies that made or did bad things. Tobacco, fast food, alcohol, fossil fuels. And only more recently has it begun to move into a proactive screen for companies doing perhaps great things in that definition. So in the 1990s, the premise of SRI was that the investor was willing to accept a smaller universe of stocks, to accept a more modest return, a non-market return, in exchange for sleeping better at night. And from our perspective, we just didn't see as much value in that as focusing completely on the private side. So it's only when our millennial team began to bring to me in 2014 and 15 the dozens of studies that had come out, and the whole paradigm shift from kind of 1.0 to 2.0, from SRI to ESG, environment, social, and governance, and this idea that not just using negative screening, but actually looking at an overall evaluation of these factors, environment, social, and governance, and including them within the financial valuation could actually lead to outsized returns. As an investor, that began to make sense to me. And the easiest way that it makes sense to me as an investor is that if we look at the market today, at no point over the last 100 years, there's never been a point where the enterprise value of companies in the public markets has been so much focused on their brand value and so little focused on what they own, machinery, equipment, etc. So brand value has become a huge focus of enterprise and market value. And brand value is enormously affected by environmental, social, and governance. So we made the commitment in 2014, actually as part of the group of foundations at the White House, to move the rest of our portfolio, our public markets portfolio, over to 100% impact. We've got about a dozen managers across equities and fixed income, all of whom are focused on using these environmental, social, and governance standards. We're focused on a benchmark return that's a full market return. We're not looking at taking a concessionary return. We believe, and it's been possible over the last 24 months in our own portfolio, to achieve a fully risk-adjusted market return by investing this way. So I would encourage all of you, as you think about the world of sustainable investing, to think about what can be done in the public markets. There's an explosive growth of mutual funds, ETFs, separate accounts. Take a look at the studies that are out there, the best of which might be a meta-study that Deutsche Bank did about a year ago, which looked at dozens of studies and kind of put all the information together. It's impossible today, if you really look at the data, not to conclude that you can achieve at least a market return in the public markets. But let me now focus a little bit more on the private markets, because that's really, the way we look at it in our portfolio is on the 50% we invest publicly, we achieve what we call collective impact. None of our individual dollars has perhaps specific impact, but when aggregated with other capital, from an influence and advocacy perspective, from shareholder proxies, et cetera, we're able to help achieve collective impact in the market. And on the private side, that 50%, each of those discrete dollars can actually be invested very directly into the issue areas that are important to us. So next slide, please. So as we think about the drivers of impact investing in the private markets, it's both social and environmental. And this is something that I think people don't really appreciate how broad these impact investing markets are. When people hear about impact investing, they say, oh, that's microfinance, or oh, that's affordable housing, right? Or oh, that's charter schools. And the fact is, it's all of that and more. On the social side, it's everything from healthcare to education, affordable housing, resources, global poverty. We attack global poverty through investing in entrepreneurs, small businesses, working capital, agricultural co-ops, etc. And then next slide, Amy, if you move to the environmental side, it's all about climate change, alternative energy, natural resources, clean water, biodiversity. I would submit today that the field of impact investing is growing dramatically. So wherever the client's interest is from a values-based perspective, whether it's social, whether it's environmental, whether it's some combination of both, over the last 10 years, this field has now evolved to the point where there are an increasing number of opportunities for that client to have those values reflected directly in their investment portfolio in the same way that they might be reflected in their philanthropic portfolio. One of the things, next slide please, Amy, that we've done at Impact Assets to try to help make sense out of this growing market is we've put together what is a free service on our website. It's called the Impact Assets 50. And it's a database that's available to anyone on the website. It's primarily used by financial advisors and wealth managers as a way to drill down to understand and appreciate a universe of fund investments that are available. And so if you look at these fund investments, we categorize them here. We just took a handful off of the Impact Assets 50 to demonstrate the broad nature of the industry. So at the top is social and environmental. At the bottom is private debt and private equity. And you can see here that there are a number of different opportunities for someone to invest depending upon what risk parameters, debt or equity, they're looking to take in their portfolio, and what particular issue areas, be it, again, microfinance, be it infrastructure, be it sustainable agriculture. And this is, again, just about a dozen examples of the 50 firms, and the 50 firms that are on the Impact Assets 50, which is recast about every 18 months, is an independent judging panel that we have of experts in the impact investing space who look at submissions from a couple of hundred funds and try to determine which 50 are the most relevant and most authentic in the industry. The one thing we don't do is we don't review and analyze and diligence the financial end of these funds. And the reason for that is that wealth managers have told us that's exactly what you guys are good at, and that if we did it, you'd want to redo it anyway. So what we do is what you've asked us to do, which is evaluate each firm's impact capacity and present a universe of firms that we believe are having authentic impact from a social and or environmental perspective, and are firms that are then worth you looking at on behalf of clients, determine from a people, process, performance perspective whether or not they make the cut for your client portfolios. So for my final slide, next slide, Amy, I just want to introduce you. So we've got almost 1,000 donor advisor clients at Impact Assets, which are individuals and families that have come to Impact Assets, that have established donor advised funds, and who are now using these funds as vehicles to both express their philanthropic giving and as impact investors to align their portfolios with their values. So two of them, both of whom are very public about their relationship with us, I selected these two. They're both personal friends, and I think they both represent kind of different segments of the market. So on the right, Liesl Pritzker Simmons is a millennial woman. She's the next generation of the Pritzker family, the Pritzker family being the Hyatt Hotel family. And she is devoting her very significant resources to a number of areas that she's passionate about, including affordable housing, global health, and others. And she's using her donor-advised fund at Impact Assets as a vehicle to invest in projects, including for her something called Builders of Hope, which is an ecologically sustainable, affordable housing initiative in the U.S. Southeast and in Africa, and also something called the Global Health Investment Fund, which is from J.P. Morgan, backed by the Gates Foundation. And it's a $100 million fund to invest in the development of new and improved drugs and vaccines for neglected drugs in the developing world. So she's picked certain issue areas, and she's actually working closely with our Impact Assets team to find funds that might not even be on our Impact Assets 50, but funds that we can help her source and diligence that meet her particular criteria. On the left, Seth Goldman represents another constituency of ours. So Seth is an extraordinarily successful young entrepreneur. His first major entrepreneurial venture is a company many of you are probably familiar with called Honest Tea, which he sold to Coca-Cola, and in the process of doing that, established a donor-advised fund with part of his proceeds in much the same way as my wife Marty and I had created our family foundation upon the sale of Asset Market. Seth is passionate about food. He's passionate about sustainable agriculture. So he's using his donor-advised fund to invest in initiatives like Beyond Meat, which is a plant-based solution. Think about a veggie burger that actually looks, smells, and tastes like a real burger. Seth is a key investor through his donor-advised fund in Beyond Meat, in Sweet Greens, which is a chain of stores serving healthy, locally sourced organic food. And he's also an investor in something called the Impact Hub, which is a WeWork-type space, a global network of these spaces focused on social entrepreneurs who are looking to build businesses with purpose. So you can see in each of these cases, the Impact Assets, we look to provide a resource for these types of donor investors to accomplish what they want to accomplish in the world and to be the vehicle that helps them do that. So there's a number of different ways that we work with the financial advisor community. There's a number of different products and services that we offer at Impact Assets to try to connect financial advisors and clients with what's happening in the impact investing space. And so now I'll turn it back over to Scott to just share kind of a collective overview of that and also some industry resources that are available well beyond Impact Assets, just out in the space. And then Scott and I will look forward to opening up the floor for questions.
Thank you, Ron. And my apologies, everyone, for the audio issues that we were having. Really apologize for that. So as we're coming to the end of our prepared remarks and get ready to answer your questions, I'd like to leave you with some additional resources that you can consult for information on DApps and also impact investing. As I mentioned earlier, Impact Assets is a nonprofit financial services organization, and our mission is to increase the flow of capital into impact investments. And we offer some innovative products to further that goal, including our donor-advised fund, which currently has more than 200 impact investments spanning public and private equity and debt. We also have 2 investable structured notes around the themes of global sustainable agriculture and microfinance with $25,000 minimums, and they can be held in brokerage accounts as they're DTC cleared with CUSIPs. As Ron mentioned, we are committed to field building by providing research and educational resources, including the IA50 database, which he mentioned, as well as 15 issue briefs on topics such as constructing an impact portfolio and perspectives of millennials with regard to investing. Here's a closer look at a manager profile for MicroVest from the IA50, which is an annually refreshed searchable database of private debt and equity managers in the impact space. And that database, as well as a full series of issue briefs exploring critical aspects of impact investing, are available on our website at impactassets.org. The latest brief is on portfolio construction and authored by Judd Emerson, an impact investment thought leader in the field. In addition to our website, there are some additional excellent resources in the impact ecosystem that you might want to consult, including GIN, which stands for Global Impact Investing Network, also the Tonic Institute, and US CIF. Of course, our business development team at Impact Assets would be happy to assist you, and you can see our regional coverage map here. Please let us know if you have any questions, would like additional information, or to schedule an in-person meeting. As I hope you've learned from our presentation today, there's a massive wave gathering momentum, one of generational proportions, and really exciting possibilities for value creation with your client relationships. And I hope that as you go away from today, you take up the baton to future-proof your firms and your practice by exploring the integration of impact investing and philanthropic products. So with that, thank you very much. Again, thanks for your patience through our audio issues. And let's now move to answering questions that you've sent in for me and Ron. So Ron, to get us started, one of the questions that we get most often is how can I title the account? If I open a donor-advised fund, can I name it after my family, for example?
You can, yeah. One of the beautiful things about a donor-advised fund is that it can be treated in much the same way as a family would treat a foundation. So amongst our donor-advised fund clients, we have family charitable funds, we have family philanthropic funds, we have the Jones Family Charitable Fund. So it's possible, and we actually encourage folks to put their own name on this vehicle in the same way that they might have named their own family foundation. It's also, I think Scott probably mentioned earlier, but I'll just mention it again because we're multi-generational in the foundation, so that's super important to us, is that donor-advised funds are designed to be equally multi-generational. The assets can be passed forward generation to generation in a way that gets kids and grandkids involved and allows for someone's philanthropy and family values to kind of be repeated through the generations.
Great. And we're getting a number of questions in, Ron. One is, what is the feedback of advisors who use the IA-50, and what additional information are they seeking that's not included in the IA-50?
Well, that's a great question. I think that so we get a lot of great feedback both from advisors and from the IA-50 managers who tell us that the database, the existence of the database has been a great connection point that has actually led to assets being invested in various vehicles. Where an advisor, the most typical way an advisor would use the IA-50 is if they've got a client interested in a particular geography or particular issue area, they'll use the IA-50 to create a universe and perhaps narrow it down 2, 3, 4 funds that could be interesting for that client to look at, and then work with the fund managers to gather and present some information to the clients and perhaps go through the due diligence process. So again, I want to point out that the IA-50 is not meant at all to be a substitute for due diligence. It's really a catalyst to create that universe where the firm and the advisor can then decide, these are the managers I want to now drill deeper on, and they can use all of the traditional ways in which they've evaluated managers in the past to do that.
Great. And Ron, this one might be more directed at you personally, but is your endowment targeting at least 5% return each year, or what is your target in terms of your own investment portfolio for impact?
Yeah, no, it's a great question. And so our target is actually, so our investment policy statement target is a fairly aggressive target. It's a 6% return after inflation. So today that would be kind of high 7%, 8% in total. It's a return that we believe, based on asset class performance historically, we're about 70% equity, 30% fixed income, with about half of the equity and fixed income portfolio invested in the private markets. And so we see an opportunity. We do a lot of work in private equity in the developing world, and we've got a track record in our portfolio of being able to achieve low double-digit returns on those private equity investments. And on the fixed income side, we actually have a track record of achieving mid to high single-digit returns on fixed income, which is critical to trying to achieve, in our case, about a 7.5 or 8% total return. Is we're very underweighted today in public fixed income, and we've moved those weightings into the private side, where from a risk-adjusted perspective, be it microfinance, low-income financial institutions, we fund worker co-ops, we do trade finance, factoring. There are a whole variety of ways around the world from a risk-adjusted, true investment perspective to earn much more than the public debt markets are paying today. And again, to get that blended return kind of where we need it to be.
Great. We have a question, and I'm going to ad-lib it a little bit here. What are the barriers that are keeping advisors from facilitating client entry into impact investing?
So it's interesting that when I first got into this space in 2009, after having our own positive experience with that 20% of the portfolio, I went out and talked to a couple of hundred financial advisors. We have relationships with several thousand through AssetMark. And it's actually, as I looked at some of the names of all of you that have called in today, it was so gratifying to see names of so many folks that I've worked with over the last 20 to 25 years at AssetMark. So we had an entree to the financial advisor community, and I talked to a number of advisors at the time about why they, as gatekeepers, were keeping the gates closed, and it came down to three things. It came down to what I called voice, products, and infrastructure. And voice was really all about advisors saying, hey, I think this is interesting, and I've got clients that are bringing up a potential interest in learning more, but I don't really feel like I've got the credibility. I don't know enough about this. My firm hasn't yet gotten smart about this, and I feel like my own credibility could be impinged if I start to enter into a conversation about this and the client comes back with a few questions and I'm unable to answer them. So that concept of voice we've been trying to address at Impact Assets with our issue briefs and other research material that basically gives the advisor an opportunity to have an intelligent, credible conversation about how these investments can fit in to a client's portfolio. And then when you get beyond voice, you get into the concept of product. And product is still a challenging one. For an accredited or qualified client, there is a tremendous growth of product available. For a client that's not accredited, a more modest retail client, there are very few product options available on the private side. There's great options available in the public markets, in mutual funds, in ETFs. So that's what prompted us at Impact Assets to launch one of the products that Scott had mentioned earlier, the Impact Assets Impact Notes, which are designed with a $25,000 minimum for the client that doesn't have the capacity to go into an accredited or qualified product, but wants some exposure to impact investing. And then the third and final element is the infrastructure. And this is all about, even as new products are being created, we're finding this now with our Impact Assets Notes, those products need to be approved by broker-dealers. They need to be approved by whatever firm the advisor's with. And even for independent advisors, the products need to be approved by whatever custodian you want to hold the assets at. So what we're finding is that's still a very evolving field, but the custodians and the firms are beginning to get it. They're seeing the demand. They're seeing the media attention. And they're beginning now to move forward to create platforms to make it easier as advisors to actually access these products.
You know, Ron, we've talked about just how popular donor-advised funds are and just the explosive growth rate. Do you think that investors or donors and donor-advised funds think differently about how they invest that capital than they would in their traditional taxable account?
You know, it's a great question. I guess I have to look at it personally and think about how we look at our family foundation and the investments that we make there versus what I would kind of call our family office portfolio and all of the personal assets that we have, where we're also directing investments to impact. I would suggest that we are just as rigorous as an investor in the family foundation because we see it as being part of our family legacy in the same way as our personal assets, many of which will end up being directed when my wife and I pass away into the foundation. So I think it's certainly possible for an investor who puts money in a donor-advised fund to say, hey, these are kind of mission-related dollars, so I'm willing to accept a more concessionary return, and there's no problem. I don't have any issue with that at all. There's some really interesting emerging impact investing opportunities where one might need to accept a below-market return to prove out a market until commercial capital comes in. We made the decision in our portfolio that we wanted to be a demonstration project, to be quite public about it, to be able to say it's actually possible in the same way as a university endowment or another vehicle like that. It's possible to build a portfolio of impactful investments and still achieve a market rate of return.
Okay, great. We got the question, why can't a DAF fulfill a pledge, and what qualifies as a pledge?
So that's more of a technical question, but the concept is basically that you can't set up and use a DAF to fulfill a commitment that you've already made prior to setting up the DAF. So I think that there's actually two things that I would point out in setting up a donor-advised fund that are really critical. So and a lot of it has to do with timing. So it's actually possible if you have a donor-advised fund and you want to make a multi-year commitment to your university or some other type of charitable project, you can make that commitment through your donor-advised fund. You just can't have made the commitment previously as an individual and then turn to your donor-advised fund and say, okay, we're going to actually fulfill it from here. So it's really about the thought process, and that's why I encourage someone who's setting up a donor-advised fund to really think about the vehicle creation early on, and then everything flows from there. And the other thing that's super critical, and we learned this firsthand as we were looking at selling our company, is you've got to set the vehicle up before you're committed to sell the asset. And often that means with privately held stock, you need to find a donor-advised fund partner who's willing to actually accept the contribution of the privately held stock before the company is even sold. And so Impact Assets has actually designed the capacity to be able to do that. And the IRS rules are tricky in this respect, but it's sometimes just really frustrating for us that we'll have an entrepreneur and advisor who come to us and say, we want to make a significant contribution to a donor-advised fund. We're in contract to sell our business. It's closing next week. We know we can set the DAF up quickly. And the answer we have to give them is we can set the donor-advised fund up in a day and fund it in 24 hours. The problem is if you've already committed in writing to sell the asset, it's actually too late to set up the donor-advised fund. So I would just encourage everyone, as you think about this with clients, to begin to get clients thinking about this earlier in the process so that when they're ready to make some decisions about philanthropic pledges and or selling major assets, that you've already got the chassis and the vehicle set up to do that.
Terrific. And with that, Ron, we are at the top of the hour, and I want to thank you and I want to thank our audience for sending in questions. We actually were not, unfortunately, able to answer all the questions, but please feel free to reach out to us, give us a call, email, and we'd be happy to follow up with you. We will be sending out the slides and the recording for this presentation to all the participants. And again, we want to thank you for your time, and have a good day. Thank you.